Welcome back, and time to switch to a fundamental conversation now. Ajay Bagga joining us. Again, we've seen a very good rally on the index. Ajay, of course, Ajay Bagga, independent market expert, here to speak with us. Ajay, always great chatting with you. Let me contextualize this for us. Uh, how have you viewed earnings for Q2? That's point number one versus what you were penciling in. How have the actual numbers translated? We're at the fag end. And point number two, this market now pushing towards all-time highs. Warranted, or would you believe that there is some exuberance in some pockets? Give us a sense.
No, I think it's much warranted.
Yeah.
Overall, we have underperformed on a relative basis versus EMs by about 30% over the last 12 months. 13 months of being below the previous all-time highs, and we have not been able to scale that number of September 2024. Normally, on a median basis, this bottoms out on 10 months. So this has been one of the prolonged downturns that we have seen without an economic recession. So there was economic growth. Of course, there was a small earnings recession. I would say there were downgrades. The downgrades have bottomed out in the previous quarter, probably. This quarter, we have seen more of upgrades than downgrades coming in. Earnings have been above expectations, so mildly above expectations. Expectations were very muted, so that has helped to have earnings above. But the good news is the earnings downgrade cycle has bottomed out. That's the first step in the market's recovery. The second now to come will be some catalyst in the form of, say, a US-India trade deal or reduction in tariffs, even if it's not a full-fledged deal. The second overhang for the markets was really what happens on the FPI flows. So flows have gone largely to tech sectors in various EMs. That's where the lion's share of flows have gone. We could not offer an AI manufacturing or AI direct beneficiary sector as such. So that became an issue for India apart from the valuations. But the good news is at 13 months of underperformance, you're not seeing this being repeated over the next 12 months. History shows that after such a strong underperformance, we normally get a very good 12 months going ahead. So we are expecting a turnaround in the markets. Might take a couple of months more, not very sure about that. Sentimentally, the US-India trade deal is one very big catalyst. Second, state elections don't normally impact the markets much. Even if it's a short-term impact, it gets watered down very soon. This time around, Bihar, the markets have seen with some trepidation because of the coalition government at the center. So 12 JDU MPs, add to that the 16 TDP MPs. Together, they would make the government a minority government. So it was very clear that the NDA needs to win Bihar. And so then the central government stays strong. Looks like that as per the exit polls last night. We can't say fully surely until the results are out on Friday. But the betting markets, the prediction markets, all are pointing towards an NDA win. That will consolidate the market. So today's gap up was more on the back of that. Globally, US government opening happens by tonight. That will help sentiments. At least the financial flows will restart. There's a big fiscal stimulus coming in the US starting January with the big beautiful bill coming into play. There is a stimulus coming. So overall, we are setting up for a Santa Claus rally by going into the year end globally, and that should help the Indian markets as well. That would be my prognosis for the next couple of months.
Fantastic. So you've set it up very, very well, Ajay. Give us a sense, this gush of liquidity, where does it go?
Yeah, you know, we are going to see some of it returning to India as well. So there are sectors in India where, again, you saw the Goldman and HSBC report. So Morgan always has been a very strong India bull right through the downturn. So we have three, four very large foreign brokerages now getting positive on India on a 12-month basis. And that's just the start, I feel. We are going to see more of that coming. So India should start getting its fair share of 7 to 10% of the EM flows should start coming back to India. That re-rating is coming. So we have paid our dues in this 13 months to a large extent. Overall sectors that will benefit, I think financials stays the top one. Infrastructure, going with this government's priorities. Rural demand has been quite strong. Urban demand has been lagging. That should catch up. So you have seen autos doing well, for example, with the GST cuts or durables, autos. These should continue to do well. I think these are some of the sectors. Turnaround is coming in IT. As I've been saying, the end use cases will start coming through. Now, very high capex is being put in on AI. And, what has been shown by previous research, there is very interesting research right from the railroads in the US in the 1860s and then railroads in Europe going through the automobile segment in the early 1900s across the world. So various bubble periods like this or boom periods like these, who benefits? The companies actually investing. The investors in those companies make 4% of the return. 96% of the return is made by the consumer of these companies. We have seen that in telecom in India, for example. What started in 97, 98, we used to pay like 32 rupees per minute and stuff like that. See where it came down to virtually free phone calls and virtually free Wi-Fi, hardly anything you're paying. So consumers have benefited. Same thing will happen with AI. It's coming. And our companies will make the end cases, the end use cases. So that turnaround is coming, but you will need people who are able to sell that to clients, people who are able to implement. Right now, implementation is very shoddy. MIT, McKinsey reports have shown 95% no impact. You try to go into any bank's website try talking to a bot or an agent. They just don't understand. And anything little bit complex, they mess it up. So uh, it will be very critical. And that's why the mid-cap IT is being more favored, that these are younger companies. Hopefully, they will be more fleet-footed than the large giants. But I would again bet, like auto, we kept saying legacy guys will move from ICE to EV, and then
Right.
they will have everybody's breakfast, lunch, dinner. Now you're seeing the EV startups are not doing that well, at least in India, but the legacy guys have taken over. So that's going to happen in IT also. The big giants will turn around eventually, and we will benefit from the AI. So the market is showing that to you with the way the IT sector has been getting slowly re-rated, but it's a good point now to get back into IT.
Good point to get back into IT, and that's exactly what the market seems to be doing over the course of this week at least. The last 3 days, the IT sector has been up. What we'll do is we'll slip into a very short break, continue the conversation on just the other side. Stay with us. Ajay, do you like defense as a pack? Is that something that is on your radar? Do you see value within it? What do you make of the run up? And or are you just waiting for execution to start to play out?
Growth is there and long term, but you will see these cycles where 3 months they go up, then they give up a big part of those gains, then again they start. So order books are great. And the mega trend is there. India will be a big defense supplier to the world, not only to the import substitution, but we will supply a lot to the global south. So all these companies will do very well, but you have to have patient capital for this. So you will see these downturns, you will see this quarter by quarter issues, but the order flows are very strong, execution capabilities are there. So these are growth stocks. You have to be very patient with them and have a 3-year, 5-year holding period. You will be well rewarded across the cycle. So overall, a very good sector to be in, but valuations are not cheap, and you will see surprises continuously every 3 months, 4 months. You will get some surprise or another.
Right.